Investing is really not complicated. I mean, the basic framework for it is simple. Now, then you have to work at it some to find the best pockets of undervaluation, maybe, or something. But you didn't have to have a high IQ. You didn't have to have lots of investment smarts to buy junk bonds in 2002, or even to do some of the stuff that was available when LTCM got in trouble. You really just had to have sort of the courage of your convictions. You had to have the willingness to do something when everybody else was petrified. But that was true in 1974 when we were buying stocks at very, very, very low multiples of earnings. It wasn't that anybody didn't know that they were cheap. They were just paralyzed for one reason or another. And that the lesson of following logic rather than emotion, is something that's obvious, and some people have great trouble with it and others have less trouble. Charlie, can you give them any more help on that?
Well, I think this is different. When we were young, we had way less competition than you people have now. There weren't very many smart people in the investment management field. There really weren't. And you should have seen the people who were in the bank trust departments. I mean, so now we've got armies of brilliant young people and all these private partnerships and all these proprietary desks and all the big investment banks. And we've got a vast amount of talent in the investment management business. And there's a lot of competition. If there were suddenly a crisis now, there would be 500 firms that would be studying it intensely, each having capital that they could commit on a hair trigger. In our day, we would frequently be all alone.
But in 2002,
we'd be the only buyer.
But in 2002, Charlie, there were tons of people that had investment experience and high IQs, and lots of money was around. Wasn't any question about money. It's just they were terrified of that particular arena.
Well, when you have a huge convulsion, which is like a big fire in this auditorium right now, you get a lot of weird behavior. And if you can,
particularly at the head table,
and if you can be wise when everybody else is going crazy, sure, there will still be opportunities, but that may give you a long, dull stretches if that's your strategy.
3 years ago, you could find a number of securities in Korea, population 50 million, advanced society, strong balance sheets, strong industry positions at 3 or so times earnings. Now,
but that took a convulsion to create that. A big convulsion.
Yeah, but the convulsion happened 3 or 4 years earlier, yeah. 5 years earlier, and plenty of smart people in Korea in the investment business, plenty of smart people here scouring. The information was all available. You can go to the internet and get information about Korean companies that's just as good as you get up from the SEC. And there they were, dozens of companies at very, very, very cheap prices. Now, where are all these smart people and with all this money?
It did happen, but if I asked you to name 20 more like it, you would have great difficulty.
I'm not going to name them. Number 8.
My name's Simon Dennison Smith from the UK. My question is this. If you were starting out today with $1 million, with a vision of building a business with 20% average growth in value over 40 years, what type of investments and investment strategy would you look to make in the first 5 years?
Well, it's somewhat interesting that we formed the first partnership 50 years ago, 2 days ago, Thursday, on May 4th, 1956, which was 105,000. That's my sister clapping. She was in the partnership. We would, if Charlie and I were starting all over again and we were in this, Charlie would say we shouldn't be doing this, but if we were to succumb to Satan and engage in same kind of activity, we would, I think, be doing something very similarly. If we were investing in securities, we would look around the world and we would look at a Korea, and Charlie says you can't find 20 of them, but you don't have to find 20 of them. You only have to find one, really. You do not have to have tons of good ideas in this business. You just have a good idea that's worth a ton occasionally. And in securities, we would be doing the same thing, which would probably mean smaller stocks. It would mean smaller stocks, because we would find things that could have an impact on a small portfolio that will have no impact on a portfolio the size of Berkshire. If we were trying to buy businesses, we'd have a tough time. We would have no reputation, so people would not be coming to us. We'd be too small a player if you're talking about $1 million. So we would not have much success, I don't think, with small amounts buying businesses. Charlie started out, in real estate development because it took very, very little capital, and you could magnify brain power and energy, or I should say brain power and energy could magnify small amounts of capital in a huge way that was not true in securities. My natural inclination was to look at securities and just kind of do it one foot in front of the other over time. But the basic principles wouldn't be different. I think if I'd been running a partnership a couple of years ago with a small amount of money, I think I'd have probably been 100% in Korea. And, I would be looking around for something that was very mispriced and that I understood. And every now and then that's going to happen. Charlie?
Well, I agree with that. The concept that you're likely to find just one thing where it'll make 20% per annum and you just sit back for the next 40 years, that tends to be dreamland. And in the real world, you have to find something that you can understand that's the best you have available. And once you found the best thing, then you measure everything against that because it's your opportunity cost. That's the way small sums of money should be invested. And the trick, of course, is getting enough expertise that your opportunity cost, meaning your default option, which is still pretty good, is very high. And so the game hasn't changed at all in terms of its basic arithmetic. And that's why modern portfolio theory is so asinine.
It really is, folks.
Yeah. When Warren said he would have been all in one country, that's pretty close to right. He wouldn't have quite done that when he had the partnership, but he would have been way more concentrated than is conventional if you listen to modern portfolio theory. Most people aren't going to find thousands of things that are equally good. They're going to find a few things where one or two of them are way better than anything else they know. And the right way to think about investing is to act thinking about your best opportunity cost.
Number 9.
It's in the freshman course in economics everywhere in the basic textbook. It just hasn't made its way into modern portfolio theory.
We don't get asked to do book reviews.
It's Andreas Rieger from Munich, Germany. Thank you very much for the open discussion that you have with us. Actually, I'd like to ask a question on a book, so I come back to the book review. Jeremy Siegel had some ideas in his second book, and I would like to understand how this would impact your investment strategies, if there are any changes from his ideas, and how you react to these recommendations that he makes. Thank you.
This is which book? Jeremy Spiegel?
Jeremy Siegel, the second book, by the try and the true triumph over the old and the new.
No, it's had no effect on us. Charlie?
No, is that the fellow who is very optimistic about common stock investment over long periods of time?
The University of Pennsylvania. Yeah.
Yeah. Well, I think he's demented.
Well, he's a very nice guy, Charlie.
Well, he may well be a very nice guy, but he's comparing apples against elephants and trying to make accurate projections.
Number 10.
I'm Bob Klein from Los Angeles. You've so eloquently stated that you can't see who's swimming naked until the tide goes out. Could you discuss the issue of trying to employ a rational decision-making process in investing or in business generally, as opposed to focusing on outcomes or results of just a few instances or over a short period of time? For example, it may not be a good idea to underwrite some insurance policies if competition has lowered the premiums too far. And likewise, in the stock market, momentum investors may get good results for a while, but buying high and trying to sell higher isn't a good long-term strategy. So I'd just like to hear you guys provide some detail on the importance of using an effective decision-making process, even though it may lead to some bad outcomes and underperformance in the short run.
Yeah, well, Ben Graham said long ago that you're neither right nor wrong because people agree with you or disagree with you. In other words, being contrarian has no special virtue over being a trend follower. You're right because your facts and reasoning are right. So all you do is you try to make sure that the facts you have are correct, and that's usually pretty easy to do in this country. I mean, the information is available on all kinds of things. Internet makes it even easier. And then once you have the facts, you got to think through what they mean. And you don't take a public opinion survey. You don't pay attention to things that are unimportant. I mean, what you're looking for is things that are important and knowable. If something's important but unknowable, forget it. I mean, it may be important, to know whether somebody's going to drop a nuclear weapon tomorrow, but it's unknowable. It may be all kinds of things. But so and there are all kinds of things that are knowable but are unimportant. In focusing on business and investment decisions, you try to you narrow it down to the things that are knowable and important, and then you decide whether you have information of sufficient value that, compared to price and all that will cause you to act. What others are doing means nothing. It's price and all that will cause you to act. What others are doing means nothing. It's what Graham writes in chapter 8 of The Intelligent Investor, that the market is there to serve you and not to instruct you. That's of enormous importance. When people talk about momentum in stocks or charting or any kind of things like that, they're saying that the market is instructing you. The market doesn't instruct us. The market is there to serve us. If it does something silly, we get a chance to do something because it's doing something silly, we do it. But it doesn't tell us anything. It just tells us prices. And if the price is out of line with where the facts and reasoning lead you, then action is called for. And if it doesn't, you forget it and, go play bridge that day and the next day see whether there's something new. And the nice thing about it is there always is something new. I mentioned the LTCM crisis. We on Sunday from people that had portfolios that were in trouble. Now, I will tell you that if you can make a lot of money on Sunday, you may not get a chance very often, but any calls you get on Sunday, you're probably going to make money on. Things are really screwed up if you're getting calls on Sunday. And all you have to do is make sure that you're the callee and not the caller on Sunday. But if you get those calls, you get a call on a Sunday and somebody says that the off the run is trading 30 basis points away from the on the run, all you have to do is decide how you handle that particular piece of information, whether it's correct in the first place, but how you handle that piece of information, whether you can play out your hand. You never get in a position obviously, where the other fellow can call your tune. You have to be able to play out your hand under all circumstances. But if you can play out your hand, and you've got the right facts, and you reason by yourself, and you let the market serve you and not instruct you, you can't miss. Charlie?
Well, I would say some of you probably can miss.
I would say Charlie can't miss, I'll put it that way. He'll agree with that. You have anything further to add on? Okay. At least I've got him off that previous subject. Number 11.
It really doesn't make any difference. I mean, we don't pay any attention to what people say about Coca-Cola stock or Gillette stock or any of those things. I mean, on any given day, 2 million shares of Coca-Cola may trade. That's a lot of people selling, a lot of people buying it. If you talk to one person, you'd hear one thing, and talk to another. You really should not make decisions in securities based on what other people think. If you're doing that, you should think about doing something else, because a public opinion poll will not get you rich in Wall Street. So you really want to stick with businesses that you feel you can somehow evaluate yourself. And I mean, Charlie and I, we don't read anything about what the economy is going to do, or the market's going to do, or what anytime I see some article that says, these analysts say this or that about some business, it doesn't mean anything to us. You cannot get rich with a weather vane.
And I would say this in terms of predictions, and I know the spirit in which you asked the question, but there's a market out there all the time, and people love to hear predictions. I mean, if I said I was going to offer a bunch of predictions today, I mean, we would have 1 million people here. I mean, they're dying to have predictions, and speeches at Rotary clubs or trade associations or whatever. They just plain love it, and that's what a whole industry is built upon. The people coming out of Washington that talk about political predictions, and I don't read those in the paper at all, because it's space fillers basically. And you mentioned Edgar Casey. Ben Graham knew Edgar Casey pretty well, but I just have never seen any utility to any of that at all. There will be some huge surprises in the world. There's no question about that. But I don't think that betting on any specific one is a very smart policy. In fact, we usually bet against them in terms of super catastrophes. We know there will be a 7.0 or greater quake in California in the next 50 years. We don't know where it'll be or when it'll be or anything like that. We're willing to pay out a lot of money if it happens tomorrow. And because people do worry about catastrophes, and in this case it's perfectly proper with insured values, but it just isn't any way, in our view, to get through economic life. Charlie?
All of these economists with 160 IQs that spend their life studying it, can you name me one super wealthy economist that's ever made money out of securities? I mean, just go down the list.
No.
No, Keynes actually, in his early years, tried to make money in stocks by predicting what business would do, and he gave it up. And then he went over to a Graham-type approach. I mean, it's very interesting to read his history on this, because he thought he could, by looking at various economic variables, pick what he called the credit cycle and make a lot of money, and he went broke a couple of times in doing it, had to borrow from people. And then he settled on buying good businesses cheap that he understood and concentrating his investments, and he did very well. It's an interesting history. But if you look at the whole history of them, they don't make a lot of money buying and selling stocks, but people who buy and sell stocks listen to them, which is, I have a little trouble with that.
I've not earned any stars for my past economic predictions, and the good thing about my economic predictions, if I even do make them, is that I pay no attention to them myself. So I really and the way we pick our investments is we just don't get into the macro factors. I can't recall a time when Charlie and I have looked at a business, either buying it in its entirety or buying pieces of it through the stock market. Macro conclusions are just never enter into the discussion. I mean, I'll pick up the phone. We've had these two in recent months, and I'll tell Charlie about it. we talk about a few things, but we don't talk about anything remotely macro, and that's really the way it'll stay. I've seen a lot of bank mergers recently, and one of the things they do because they want to cut the costs and justify a merger, which they're dying to do. I mean, that's the reason they cut costs they wouldn't have cut if they weren't dying to do the merger in the first place and get bigger. But frequently, I know one in particular that I'm thinking of that, they'll cut out the economics department. I always wonder why the hell they had it in the first place. Because what do they do? I mean, if the guy comes in and says, I think GDP will be 4.6 this year instead of 4.3. So what? I mean, you're still trying to make every good loan you can make, and you're still trying to take in deposits as cheap. You should be trying to cut costs wherever you can. It's got nothing to do with running the business. But it's fashionable, and every bank had its economist and economics department, and when a big client would come in, they take them to lunch, and it always has struck me as it's just a lot of nonsense. So if we ever get a economics department at Berkshire, sell the stock short.
There was one other item in here, I believe, which I think achieved a little added relevance in the last year. I said, we therefore need someone genetically programmed to recognize and avoid serious risks, and then I put in italics, including those never before experienced. And then I said, certain perils that lurk in investment strategies cannot be spotted by use of the models commonly employed today by financial institutions. Well, I think that proved to be somewhat prophetic of what happened last year. All of these places had models. I mean, the major banks, the major investment banks, and they would meet weekly at a risk committee probably and go over their models, and all of the statistics would be printed in nice columns and everything, and they didn't have the faintest idea what risks they were involved. You really need, in the investment world, someone very solid, someone you trust, reasonable analytical skills, but you also need someone that actually can contemplate problems that haven't popped up yet, but which are starting to become possibilities in terms of new financial instruments or new behaviors in markets and that sort of thing. And that's a rare quality. I mean, that inability to envision something that doesn't show up in your past model, can be fatal. And Charlie and I spend a lot of time thinking about things that could hit us out of the blue that other people don't include in their thinking. And we may miss some opportunities because of that, but we feel it's essential when managing other people's money, or for that matter, managing our own money. So I would say that you might go back and read the 2006 annual report again, but those are the criteria we're looking for, and we have identified as being met by the four people we're thinking about. Charlie?
Yeah, you can see how risk averse Berkshire is. In the first place, we try and behave in a way so that no rational person is going to worry about our credit. And after we've done that and done it for many years, we also behave in a way that if the world suddenly didn't like our credit, we wouldn't even notice it for months.